Hey guys, it's Nick here from Nick's Finance Tricks. Today we're going to use my stock screener spreadsheet and my stock valuation spreadsheet to search for and value a couple of example stocks. Okay, so this is my stock screener spreadsheet. I'll just update the ASX list of companies. So what I'll do, I'll pause the video frequently throughout this tutorial, because there'll be a lot of downloading data, so that'll just save time for you guys. Okay, and so the tags I've got are just the preset ones which I cover in my previous video. So we'll just download that information from Yahoo Finance with this button. Okay, so that's all the data from Yahoo Finance that I am interested in looking at. For the purpose of this video, I'm just going to screen based on the price earnings ratio and price book ratio. So I've already got some conditional formatting in there that weans out the more expensive stocks. So I'm just going to filter this by color, this one too, and then now I'm just going to search through these green stocks for a stock that takes my fancy, which I'll probably base it on market capitalization. So let's just have a scroll through here. I like the big market cap ones. Here we go. Metcash, food and staples. Let's check that one out. So I'm going to use my stock valuation spreadsheet now. Type in our symbol, MTS, our market for comparison, which is the ASX 200, and update all the data. Then I'm going to update the sector, market and price. Now I'll perform all the beta calculations so we can determine the cost of equity. And once that's all downloaded, we will have to populate these three cells here. So today I'm going to use Morningstar, just the free member subscription. So I've already preloaded Metcash into here and signed in and went to the historical financials tab, and then historical financials tab again. And we're going to check out the return on equity, and I'm just going to take the 3-year average because Morningstar doesn't provide more than 3 years worth of historical financials for free members. So I've already put these values into a spreadsheet and taken the average, and I'm just going to copy that in to a spreadsheet here. So return on equity I had at 15.43%. The payout ratio, 3-year average at 32%, and the previous, or the 3-year average dividend was 8 cents. So I might just change that there. Okay, so now we've finished with this CAPM model, and we can look at our results down here. So if we consider zero growth of the company, which is a conservative estimate, we would value the company around $2 per share, comparing that to its previous close, which was $2.16. So our estimate is that it's currently overpriced based on zero growth. But if well, you might notice here as well, we're getting a negative intrinsic value when we use the growth rate that we calculated here. But it's clear that 10% isn't a sustainable growth rate, even though that's what we've calculated. So we might just drop that back to 3%, which is a pretty conservative estimate of company growth. And that gives us a much better estimate of the intrinsic value. So we'd be looking at, about $7, which is substantially higher than the previous close. So this one might be a good investment. Even when we look at our other method for valuing the stock, where we just hold it for 40 years, you're still looking to get $2.50 at least. Okay, we'll have a look at the CAPM2 model real quick. So this model also indicates that the Metcash is presently undervalued when we use daily and weekly holding period returns. Monthly, a little bit less accurate and getting some pretty sporadic results there. I should mention here that this spreadsheet will only calculate whether or not the company is presently undervalued. You'll still need to do, I recommend you still do a fundamental analysis of the company's financial reports. You'll also want to make sure that the company is managed by competent leaders and that the company has long-term prospects, and the company has to be stable and understandable. You're probably already familiar with those rules. I believe it was Warren Buffett who said those are the 4 rules for investing in a company, and he's done pretty well for himself. You'll also want to check whether the company you're looking at investing in fits in with your current portfolio. And there's a few spreadsheets that I'll be uploading soon, which might be able to help you with that. So stay tuned for them. Okay, but in summary, Metcash is undervalued at its present market rate according to this model. Alright, let's have a look at another company. Check out Screener again. So keep on scrolling down here. Still looking for large market capitalization companies, but avoiding the real estate ones. So I was actually looking for a company called St. George Mining. I thought I found it in the screener, but I must have found it somewhere else. But we'll just have a quick look at it as an example. So I've already got it up on the Morningstar website. So when you look at this company's return on equity, you notice that it's consistently negative, and its payout ratio is 0, and per share statistics, you'll see the dividends are also 0 for the past 3 years. So the reason why I brought this one up is because it's a good example of when this spreadsheet, the stock valuation spreadsheet, is not suitable. So if you really want to analyze that company, St. George Mining, you'll have to come up with some other method. But if it's got historical financials like this, you might not want to invest in it anyway. So, okay, and then last example for today, we will scroll up a bit. We're looking for Crown, which is neither here in this list. So I think when I ran this screener on Friday, a few days ago, some of the prices have changed. Anyway, we'll have a look at Crown briefly. So I've already calculated the 3-year average for return on equity, payout ratio, and dividends. So I will pop them into a new stock valuation spreadsheet. Yep, I don't mind about that. So I'll just quickly download all the information and then unpause the video. Okay, so I've downloaded all the information for Crown Resorts Limited. We see we have a previous close of $11.42. We'll have a look at our CAPM model. We have all of our statistics downloaded here, so we'll just include our 3 pieces of information here. We've got 11.27% for return on equity, 78.67% for payout ratio, 49 cents for previous year's dividends. So this is a relatively achievable growth rate, 2.4%. It's not too high, not too low. So that's all looking good. But when we scroll down to the values, our intrinsic value from our dividend discount model, we start to see some pretty spurious results here. So we head back up here to the sample statistics, we notice that we've got a negative expected return for the market. So in this case, it's better to use our second CAPM model, which considers the expected value of the ASX 200 over since its inception. And what that yields is intrinsic values which are very similar to our previous close, one of which are exactly the same. So in summary, it's probably not an undervalued stock and probably not worth investing in. So in summary, of the three companies, one possibly worth investing in is Metcash Limited, but remember to do your additional fundamental analysis. And once again, thanks for listening, guys. I hope you find this video useful and the spreadsheets useful. Okay, see you next time.